Welcome to the deep dive. So if you're serious about business, you've definitely heard the term cost volume profit analysis or CVP.
Oh, yeah.
And when most people hear it, their brain, jumps to one specific thing. Break-even point in units.
That's exactly right. We've all done that homework problem, haven't we? How many widgets do I need to sell to cover my costs?
Right.
But in the real world, thinking only in units is, well, it's often the least useful way to look at it. It's kind of level one thinking.
It is. The calculation itself is easy, but it's just not very flexible. So our mission in this deep dive is to get you beyond that level 1 calculation and really up to level 3 strategic thinking.
We want to show you why focusing on dollars, and specifically the contribution margin ratio, is just an indispensable tool for forecasting and, frankly, for assessing risk in any complex business.
We're basically transforming CVP from like a math problem into a powerful framework for actual management decisions.
Exactly. By the end of this, you'll see why the dollar approach is really the only way a business with multiple products or services can reliably set goals and measure how they're doing.
Okay, let's unpack this. We'll start with a pretty simple company to build our foundation. We're looking at some data from a place called Jules Corporation.
Yep.
They sell a product for $200 a unit. The variable cost is $110, and their total fixed costs are $63,000.
So if we use that traditional unit method, the contribution margin per unit is what? $200 minus $110, so $90.
90 bucks.
You take the $63,000 in fixed costs, you divide by that $90, and you get your 700 units for break even.
And if you want that in dollars, you just do a quick multiplication. 700 units times the $200 price gets you to $140,000 in sales.
Simple.
Very simple. But now we're going to look at that exact same data through a different lens, through the ratio approach.
This is where we shift the focus entirely onto revenue dollars, which, is the language business leaders actually use. Right. We need to find the relationship between those costs and the selling price, but in percentages.
Okay, so let's start with the variable cost ratio.
That's just the variable cost of $110 divided by the selling price of $200.
Which gives you 55%.
And conceptually, what that means is for every single dollar of sales that comes in, 55 cents is immediately gone. It's used up to cover the direct costs of making that thing.
And the other side of that coin is the contribution margin ratio. So that's the $90 contribution margin divided by the $200 price.
Which gives us 45%. So for every $1 in sales, 45 cents is the, let's call it the powerful money. That's the money that first covers all your fixed overhead.
And then after that, it becomes pure profit.
And this is a really foundational idea you just have to remember. If you sell something for $1, the piece that goes to variable costs plus the piece that becomes contribution margin.
It has to equal $1. It has to be 100%.
Always. So if your VC ratio is 55%, your CM ratio must be 45%. That relationship is constant, whether you sell 1 unit or 1,000,000. It creates this beautiful consistency.
Which is why managers love it. But I have to ask the big question here, the one our listener is probably thinking right now.
Go for it.
If we just show that calculating the unit break-even and then multiplying by price is so fast, why bother with all this, ratio gymnastics? When does the unit approach just become obsolete?
That's a great challenge. And look, the unit calculation is fine for a single product that never changes. But the ratio approach is so much better for strategy because the unit calculation just completely collapses in like 3 major real-world situations.
Okay, situation number 1.
Multi-product companies. Let's say Jules Corporation also sells, I don't know, bats and helmets. The glove has a $90 CM, the bat has a $60 CM, the helmet a $45 CM.
You can't ask the manager, how many units do we need to sell? It's apples and oranges.
Exactly. You can't just add a glove to a bat. But the dollars approach lets you calculate a single weighted average contribution margin ratio across everything you sell.
So it converts everything into revenue dollars, which you can compare. It unifies everything.
It unifies the business. And then there's situation 2, service businesses. Super common now. Think about a consulting firm or a law practice.
There are no physical units to count. You don't sell one legal service. You sell hours, projects, retainers.
All measured in dollars. In that world, the CM ratio isn't just better, it's the only tool you have. You figure out what percentage of every dollar of fees goes to variable costs like travel, and the rest is your CM ratio to cover salaries and rent.
And the third situation is maybe the biggest headache for managers, a changing product mix. Let's say Jules Core suddenly sees a huge demand for their low-margin helmet.
You might be selling more units than ever before, but if your mix shifts away from that high-margin glove, that break-even calculation you did in
This
units.
is now totally useless. Instantly.
Precisely. The dollars approach, though, it still works. You just update your weighted average CM ratio. It's built for change, for volatility, and that's why we have to move beyond just counting units.
That makes complete sense conceptually. So if the ratio is the key, how do we actually put it to work? What's the formula that lets managers make quick decisions with this?
Well, this brings us to the managerial application. The formula that comes out of all the CVP principles is actually, it's elegantly simple. Break-even sales in dollars is just your fixed costs divided by your contribution margin ratio.
Let's run that for Jules Core again.
Yeah.
So $63,000 in fixed costs divided by 0.45.
And that gives us $140,000. It confirms the math, but it uses a formula that can scale to any business, no matter how complex.
And the reason that structure sales times the CM ratio equals fixed costs is so powerful is its flexibility.
It's all about flexibility. It tells you that every dollar of sales multiplied by that CM percentage has to generate enough total contribution to perfectly cover your fixed costs. That's the break-even point.
And once you really get that structure in your head, the managerial applications become instant. You don't need a spreadsheet every time.
No, not at all. Imagine a division manager tells you their fixed costs are $100,000, and they figure their product mix has about a 40% CM ratio.
You can instantly tell them their break-even is $250,000. It's a mental shortcut.
A powerful one. And it lets you easily calculate things like the margin of safety. Let's say that same division expects to sell $300,000.
Their break-even is $250K, so they have a $50,000 margin of safety.
And that $50,000 figure means something to everybody, to an executive, to an investor. Saying we have a $50,000 buffer is so much more useful than saying we sold 250 extra units.
It puts performance into financial terms that actually matter. Okay, so we've mastered the static break-even point.
Yeah.
Now we need to move into the really high-stakes territory, strategic planning.
Right.
This is where we use that same CVP structure for sensitivity analysis to figure out what happens when things change.
Exactly. This moves us from just defining the zero profit line to actually assessing business risk and making decisions when you don't know what's coming. We have to understand the impact of shifts.
Let's stick with Jules Core. But now, instead of just breaking even, let's say they have a target profit goal of $36,000.
Okay. So originally, with their $63,000 in fixed costs, that meant they had to sell 1,100 units to hit that goal.
Now for the shock. The company invests in new facilities. Fixed costs jump from $63,000 all the way to $81,000. That's an $18,000 increase.
And a critical question for management is, how many units do we now need to sell just to maintain that exact same $36,000 profit?
We just use the structure we learned. The new total contribution margin we need has to cover the new fixed costs plus the target profit.
That's it. So $81,000 in new fixed costs plus the $36,000 in profit. That means we now need a total contribution margin of $117,000.
And since the CM per unit is still $90,
We divide that $117,000 by the 90 CM per unit, and the units needed, they jump dramatically, from 1,100 to 1,300.
Okay, let's pause there because the interpretation is the most powerful part.
Yeah.
An $18,000 increase in fixed costs forced them to sell 200 more units.
Just to stay in the same place, profit-wise.
And if you translate those 200 units back to revenue, that's another $40,000 in sales they need to generate.
This is the multiplier effect in action, and it's something a lot of managers don't intuitively grasp. For every $1 increase in fixed costs, they needed $2.22 in new revenue.
Wow.
Just to keep their profit stable. That tells you your cost structure is amplifying your risk.
That is a serious calculation. It means if a supplier change hits you with, say, 10 grand in unexpected fixed costs, you don't just need 10 grand in new sales, you need over 22,000 in new sales to protect your profit goal.
And now you see why CVP is a risk assessment tool. The framework is just so flexible. Let's say instead of fixed costs, your variable costs go up from $110 to $115.
Okay, so that immediately shrinks our CM per unit from $90 down to $85. We still need that same $117,000 in total CM, though.
Right, so you divide $117,000 by the new 85 CM, and the units needed jump even higher, to 3,376. It just isolates the impact of every little change.
Or let's look at the flip side. Let's say the sales team works some magic and raises the price to $210.
Now your CM per unit goes up to $100. So you take the $117,000 you need, divide by 100. You only need 1,170 units.
The framework lets you test all these scenarios instantly. And this is where the real managerial wisdom comes in. We saw that an $18,000 investment required 200 extra sales.
So the decision for the manager is no longer theoretical. It's a very clear quantitative hurdle.
They're not just asking, should we invest?
They're asking, will this investment, which costs us $18,000 in fixed costs, reliably generate at least 200 more unit sales? Or will it lower our variable costs enough to compensate? If the answer is no, then that investment is a bad deal for our profit. The framework gives you that line in the sand.
So what does this all mean for you as you're trying to apply this? We started with a simple mechanical task calculating break-even in units. Then we moved to the conceptual power of the CM ratio.
And we finished with strategic application. At the end of the day, the dollar approach and the sensitivity analysis are just more useful because business is done in dollars. Reports are in dollars, goals are set in dollars.
By mastering both, you get flexibility and, much deeper analytical ability.
The knowledge you walk away with today is really how to analyze business risk with precision. The true value here isn't about finding one static point. It's about charting how vulnerable your profit is to all the shifts in the market.
Think back to that Jules course scenario.
Okay.
An 18% increase in fixed costs required an 18% increase in sales just to stand still. That's a very sensitive model.
And that leads to our final provocative thought for you. Take a hard look at your own cost structure. Does your reliance on fixed costs make your profitability fragile, sensitive to unexpected shocks? Or is your business resilient enough to absorb them? Understanding that sensitivity, that's the first step to building a truly robust business model.